The Income Tax Act 2025. Today is day 35 and I am studying section 48 and 49 of the act. Starting with section 48, which deals with the deduction available to the growers and manufacturers of tea, coffee, rubber in India during the tax year. So the business should be both growing and manufacturing of these three items: tea, coffee, rubber. Then deduction will be computed as per the provision of Schedule 9, which is a different schedule. The details of that schedule are here. Withdrawal or utilization at a time. Okay. Deposit. In order to obtain benefit of this section, they have to deposit some amount in either a special account maintained with NABARD or some deposit account which is maintained for the purposes specified in the scheme. And they have to deposit that amount in a specified timeline, which is either 6 months from the end of tax year, which means 6 months after the end of tax year, which is 30th September, or the due date of ITR, which is usually 31st October for companies. Whichever is earlier, whichever of them comes earlier, they have to deposit by that date in order to be able to claim this deduction. Then the amount of deduction, they will get lower of either the actual amount, lower of either of actual amount or 40% of PGBP, but before reducing this deduction from the PGBP income. We'll take total income from a business, let's say 10 lakh rupees, and then we'll see 40% of that is 4 lakh rupees, and the actual amount deducted, if it is like 3 lakh rupees, they'll get a deduction of 3 lakh on rupees 10 lakh. Then which means their total income will be 10 lakhs minus 3 lakhs, which comes to 7 lakhs rupees. And from that 7 lakhs, they will divide their income into agricultural and non-agricultural income based on the specified ratio, like 60/40 or 75/25. And then that amount that they deposit, they have to use it for only purposes prescribed by the tea, coffee, rubber board. And in case they misutilize it, it becomes their PGBP income in the year in which they misutilize it. Some examples are here. If they use it to purchase plant and machinery in for office premises or residential accommodation, this deduction will be withdrawn, and that amount will be taxable under the PGBP income for that year. Then there are for office appliances, but here is an exception of computer. If they purchase computer from that amount, it's allowed. Plant and machinery on which 100% deduction has been already allowed. New plant and machinery for industrial undertaking in the business of construction, manufacture, or production. And then there is this little point that expenditure incurred shall not be allowed as deduction as it was already allowed. Means when in the tax year they deposit this amount in that specified account, they receive a deduction on such deposit. And then when they incur some expenditure using that amount, they will not again get a deduction for expenditure, because that will be double deduction. They will only receive the benefit of deduction only once, which means at the time of deposit. And here's the point: deduction should be allowed before setting off of past losses, which means after we obtain the income and then we divide it into agriculture and non-agricultural income. Then from non-agricultural income, we set off the past losses. If any amount is withdrawn from NABARD, our site restoration account should be utilized. It should be utilized in the year of withdrawal only. Let's say an SSC withdraws an amount on 20th of March 2026, and he uses it on 1st of April 2026, then it will become taxable for him in the year 25/26 only, because he did not utilize it in the same year as he withdrew it. Then is the point of in case he purchases a machinery using that amount, he will be able to claim depreciation on such machinery in the future years. When an asset is Now, if he has purchased an asset, he should keep that asset for at least 8 years from the end of tax year. And in case he sells that asset, it will be deemed to be his income in the tax year of sale or transfer. So let's say an SSC purchased an asset using the amount in deposit, which was an eligible asset, for like, let's say 6 lakh rupees. And after few years, only 2 years, he sold such asset, but he had to keep that asset for 8 years only. He sold that asset for, let's say, 8 lakh rupees. So out of this 8 lakh rupees, 6 lakh will become his PGBP income. 6 lakh will become his PGBP income, and the excess of the amount received over the cost or over the amount of deduction he claimed will be taxable as capital gains. This will become capital gains of the SSC. Now, this rule does not apply in two cases: when the asset is transferred either to government, local authority, or statutory corporation or government company, and in case of succession of firm to company. These are the two cases where they can sell the asset even before completion of 8 years from the end of tax year. Then there is a condition about where any amount is outstanding in deposits is withdrawn. When such amount is withdrawn, then it depends if it's withdrawn on account of closure of business or dissolution of firm, then it will become taxable. But in these three cases, which means death, partition, or liquidation, it is not taxable. And after that, the SSE is required to get his books audited and furnish a audit report as per the due date specified under section 63, which means 1 month prior to the date of filing. And these are the conditions which are common for section 48 and 49. Here onwards, these conditions are common for section 48 and 49. Section 49 is almost similar to section 48, but it provides the benefit to business of prospecting, extraction, or production of natural gas or petroleum in India during the tax year. So people SSC engaged in this business will get deduction under section 49. They have to deposit such amount in a special account maintained with the SBI or site restoration accounts. And the condition is before the end of tax year. They don't have the condition of these conditions 6 months or due date of ITR. Only one condition is which is before the end of tax year. And here's also one difference. They have to calculate 20% of PGBP as the maximum amount of deduction that they can claim. And obviously, the purposes for which they can use the amount is prescribed by the Ministry of Petroleum and Natural Gas. Rest everything is same for both the sections, and there is this point: amount outstanding is withdrawn. Then in case of this petroleum business, it's fully taxable in all cases. There is no condition of death, partition, or so in such case. That's all for today.